One of the big four banks have cut their interest rates for their fixed loan rate. And this could be a sign of things to come with mortgage rates around the corner. Now, a lot of this is linked with mortgage stress. So in this video, I want to cover off what's happening with the mortgage cliff and the mortgage stress situation within the Australian property market, as well as that, what it could mean by one of these big four banks starting to cut rates. Are we going to see interest rates cut a lot more, or is this just a one-off? If you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, if you aren't following me on Instagram, you definitely should because we run some giveaways as well as some Q&A. So I'm going to leave a link in the description below, or you can simply search up Personal Finance with Ravi and you'll see my face pop up, and you should definitely smash that follow button. As of recently, with the interest rates going up and staying up for so long, we've had another 800,000 Australians fall into mortgage stress. And yes, that does sound like a lot because it actually is. I want to cover off a couple of key stats around what's happening with mortgages and why one of the big four banks is doing the opposite to what's actually happening out there. Because we've been told inflation's high, the RBA can't cut rates, and then there's calls by others saying that interest rates should actually go higher. So let's dive into it. Now, what we have here is the rate of interest rate changes. What this shows us is the percentage increase from our existing cash rate. And Australia is above Canada, New Zealand, United Kingdom, and the United States. So when you have calls from economists in America saying that, hey, the Fed is actually going to cut and there's probably an 87 to 90% chance that happens in September of 2024, what does that mean for Australia? Where we've increased our rates at a faster pace, it's been more steep, yet we're not talking about interest rate cuts probably until 2025. Now, in saying that, one of the big four banks, CBA, has come out and suggested that they think the first interest rate cut will happen in November of 2024. Now, if you're watching this in July, we're only a few months away from that. So we will find out definitely what's happening. But what is really putting pressure on all of these banks to not decrease their rates and the RBA to not increase or decrease rates, because we're in a very tricky situation. And I'm going to make it really simple for you. If inflation's high, interest rates have to stay where they are or increase. But if the RBA was to increase, they would also have to look at unemployment and retail spending. And right now, those two figures are looking very dire. So if you looked at those two numbers, you'd say, well, we need the RBA to cut. Whereas if you look at inflation, you'd say the RBA needs to increase, and hence why we have a stalemate. It is why the RBA isn't moving the interest rate, because they're just hoping for a soft landing at this point. Now, this graph here is pretty telling. It's the debt to service ratios for the household sector. It's effectively the percentage of how much you put towards servicing your debt. And what we can see is since 2020, we've just been in a vertical line up, and that's because times are really tough here. As interest rates have increased and people borrowed at such low figures, now we're having to repay the same debt at almost 2 to 3 times more in terms of interest expense, which is pretty crazy. Now, here's something from Roy Morgan Research. And what we can see is the percentage of mortgage stress for owner-occupied mortgage holders. What we see here in 2008, 2009, this is during the GFC, we saw it quite high. And what we're seeing is ever since 2020, all those lower interest rates, we've continued to see it higher. But what's interesting is that we're starting to plateau and potentially start dropping off. Now, there's a couple of reasons for this, but most notably is that people have found a lot more equity in their properties. So they have a couple of choices. If you did decide to sell, the percentage of people in profit right now is at almost all-time highs. Which means that if someone did buy 2 years ago and then they decided, hey, I can't hold this property any longer, I'm gonna sell, they probably walk away with more money in their pocket. The worst case situation in this would be that if you had interest rates go up, people are forced to sell, but the market pulled back. And if that happened, you would be forced to sell at a loss, which would then mean more people would hold onto those properties. And that is what would lead to an absolute collapse. Now, one thing that could further emphasize the big problem when it comes to mortgage stress, and it could get a lot worse, is employment. Now, I covered off this topic in detail. You should definitely go check out this video. And one of the graphs I shared in that was exactly this, which is job ads versus applications per job ad. And what we've seen in the blue is applications per job ad, and in the red being the job ad itself. And what this effectively says is that companies are hiring a lot less, however, more people are looking for work. And that is what will start causing the unemployment number to start going the other way. And that therefore will put further pressure on the RBA to decrease rates. So after knowing all this, why would one of the big four banks come out and start cutting rates? Well, let's dive into which bank it is and why they're actually doing this. So NAB has become the first of the big four banks to cut its fixed term mortgage rate this year. The move will only affect owner-occupiers on a 3-year fixed rate paying principal and interest, but it's been called a strategic decision amid fears of 1 or possibly 2 rate rises from the RBA in the coming months. So there's speculation still out there, as I mentioned, because inflation is so high, people think that interest rates will continue to go higher. But I'm going to tell you a little bit in a second when it comes to hints and why this is so important and is why you should pay attention. The 3-year fixed rate for a mortgage holder that owns at least 30% of their property has fallen by 0.6 percentage points from 6.59% to 5.99%. If the loan to value ratio is below 30%, the fixed rate has fallen from 6.64% to 6.04%. This is a strategic move from RBA in a bid to test whether there's an appetite among borrowers to revert back to fixing. Rate City Research Director Sally Tyndall said. Now, if you think back a couple of years ago where variable rates may have been at 3.5% to 4%, whereas fixed rates were much lower than that. That's when we had rates below 2%. I know it sounds crazy at this point, but they were at 2%. What a lot of people did was they started fixing their rates at that point. So the fixed rates were lower than the variable. Now let's work out why banks will look at fixed rates and variable rates and why it could be a strategic move. When a bank goes out there and says, I'm going to increase the fixed rate above the variable rate, you would sit there and think, well, I can pay the variable rate, I have maximum flexibility, so why would I go and pay a higher rate, lock myself in for the next 3 years, I'll just take up the variable rate. In order to understand why the bank thinks like this and what their strategy is that they believe that the interest rates probably are going to be lower in the near future. So if they offer a 3-year fixed rate and they say, okay, we're happy to give you 6%, as long as you lock yourself in now, you may think that's a no-brainer because I'm already paying 6.5% when I'm on variable. Yes, sure, I have all this flexibility, but what happens if interest rates go up like they have been? So I'm gonna go and say, I'll take up the fixed option. So you go ahead and you fix the rate and it happens to be at 6%. Although the variable rate right now is at 6.5%, why would the bank actually do this? Now, in their opinion, they believe that the interest rate in 3 years' time will actually be much lower than 6%. But because you locked yourself in, they're gonna start making profits on the difference. So let's fast forward 24 months from now, and you find that the variable rate is 4.5%. Whereas you fixed your rate 2 years ago at 6%. That gap in between is the price you pay for certainty. And that is where the bank goes, hey, look, I'll profit on that money. Now, it does work the other way around where they believed that interest rates were going to be lower and they ended up having this fixed rate that was much lower because of the volatility, and a lot of people were able to go and profit from that. So if you had gone and fixed your rates at 2% and the variable rate over the next 3, 4, 5 years happened to be at 4.5% or 5%, that gap is your profit. So it does work the other way, but in most situations, emotions get the better of us, and a lot of people fall for the trap saying, hey, interest rates have been so high for so long, I think they're gonna go much higher, and screw themselves over, fixing their rates at what looks like a lower rate in the short term, but over the long term could actually work out worse for you. Now, I know this really, really well because I did the same thing with my first property. I went out there and I said, hey, I looked at the interest rates, I looked at the fixed rates, and I said, yeah, this makes sense. As soon as the fixed rate started dropping, I fixed my rates at that point. And what I saw over the next couple of years is that variable rate go lower, 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 along with my own mood completely going down, saying I'm losing money because I made a silly decision. It will be very interesting to see over the next couple of months who is going to make a move first. Right now, NAB's made it on one product, but they could simply go next month and say, we don't really have an appetite for this, and they can increase the rates again. But I don't think this is a notable move yet. If we start seeing 3 to 5 banks do this and they do it across different products, that is going to be your telltale sign that they believe, and they have people much smarter than you and I, although that is arguable, we could find ourselves getting a hint or an insight into what they believe the interest rates will be in the next 24 to 36 months. So right now, we probably are closing in on the end of this rate hiking cycle. And if you're looking at inflation purely, you would probably believe there's 1 or 2 more rate hikes. And in that case, you should probably budget for that. But if you're looking at the economy as a whole, I find it really hard to believe how they're going to increase interest rates from this point. If they did, I feel like the steep fall afterwards would be even steeper. I want to know what your thoughts are around what you're paying as your interest rate. So down in the comments below, why don't you just put the interest rate that you're paying, and it'll just give us a really good guide of where the market is right now. I hope you guys have enjoyed this video. If you have, smash that like button, subscribe if you haven't already, and I'll catch you guys in the next one. Thanks, guys.